We open on a nightmare scenario. A stock chart falls off a desk. Headlines scream inflation recession. Workers leave an office in a panic. Traders frantically sell stocks that turn to worthless scraps of paper. Then it all slows down. We zoom out from a painting of a man who seems unfazed by the madness, J.P. Morgan. When most investors saw boom and bust cycles, Morgan saw opportunity. He once said, "Men who can persuade themselves that little things do not matter, who can go steadily and sanely ahead in the performance of their duty, are the men who will succeed." In this video, we look at some of the timeless rules in J.P. Morgan's playbook for building wealth. J.P. Morgan was many things: banker, art collector, yachtsman, bear hunter. But how did he start? Well, if you listen to his detractors, maybe not as an innocent young lad. But actually, it appears that he was pretty well behaved. His mother said, "I never had to punish him, for fear or shame or disgrace was sufficient." As a youth, he knew the value of $1, having had several jobs, including working on his father's railroad. It also instilled in him a lifelong love of trains. But it wasn't enough for young J.P. As a teenager, he would make baits that his friends couldn't beat. This led him to Wall Street, where he began to work as a runner, eventually joining a brokerage firm. By 24, he was a partner. And at 29, when Lehman Brothers needed someone to reorganize its shipping business, they sent for J.P. They liked what they saw. In fact, they liked it so much they made him a partner. Soon after, Morgan managed the company's reorganization and gained control of International Mercantile Marine, which transported 20% of the world's cargo. Later, he engineered the merger between two steel companies to create U.S. Steel. The company went public. That IPO remains the largest to date. Throughout his life, J.P. Morgan collected art and amassed one of the best collections of American paintings. And the museums that were created in his name still display them today. Morgan was known for his vast wealth, for pulling the markets out of a ditch in 1907, and for his love of good design. Few know about his personal collection of over 3,500 books, most containing something like 5,000 to 10,000 drawings. Now, we don't want to spoil the ending, but it's important to understand how these 5 core principles shaped not just his career, but his life. Because it's not often you find someone whose career and personal lives align so neatly with their investment philosophy. As we go through each principle, take note of how they apply to your own life. If you master these skills, you'll be able to build your own fortress balance sheet and live the life that you want. Chapter 1, Character is Currency. This was J.P. Morgan's first rule, and it remains one of the most important lessons in investing. Morgan famously said, "The first thing is character. Everything else is secondary, and if you want to use the vernacular of today, character is currency. It's the basis for your credit score, which determines whether or not you get a loan and how expensive that loan will be. It's why a handshake can seal a deal. And it's why the CEO of a company has such a big impact on its valuation. People invest in people, and when you build up your character, you're increasing your own personal brand. In turn, this allows you to do more interesting work, which should lead to more money. So remember, your reputation matters. Keep your word and do what you say you're going to do. Always tell the truth. And above all, do not compromise your values and your ethics. When you do, you build trust. And when others trust you, they lines want to work with you and invest in you because they know that you are an investment in them. Chapter 2, Value Greater Than Price. Let's face it, we all like something for nothing. At least that's the theory behind memes and meme stocks. The problem is when you flip the switch, the house doesn't turn on. It's the difference between price, which is what you pay, and value, which is what you get in return. J.P. Morgan put it succinctly. An investment in securities does not begin to be really profitable until the margin of its purchase is sufficient to justify a reasonable allowance for interest on the capital employed. For example, take a look at AMC stock. Here's the chart. Compared to the S&P 500, it's a wild ride. Meme stocks are great entertainment, but they don't always reflect the true value of a company. Take GameStop. One analyst valued it at $27 a share, while another valued it at $100. The media calls it the mother of all short squeezes. But one thing's for sure, those who bought it for fun are left holding the bag. Now, this is not to say that there aren't great opportunities in meme stocks. However, most investors should focus on value over price. This is how you achieve long-term success. And as Warren Buffett says, price is what you pay, value is what you get. Chapter 3, Be Calm in Crisis. Let's travel back to October 1907. The Knickerbocker Trust Company defaults, sending shock waves throughout the entire banking system. Thousands show up at banks demanding their money, only to find that they cannot withdraw their cash. News outlets call it the greatest financial panic in history. At the time, J.P. Morgan was traveling in Europe. He cut his vacation short and immediately set to work. He consolidated the markets and reorganized banks, even putting his own fortune on the line. After 4 days, the markets stabilized, but that's not the story. The story is that throughout the crisis, J.P. Morgan remained calm. As the crowds roamed the streets, knocking on bank doors, Morgan stayed inside his apartment reading books. Sure, there's a chance that he had nothing better to do, but that's not the point. Calmness of mind is a powerful tool. And we see it again in 2008 when Warren Buffett purchased a failing insurance company called Geico. Buffett bet that it would survive, and it did. Sometimes it feels like the world's gonna collapse. That might be true, but if you stay calm, you'll be able to think clearly and come up with solutions that others haven't considered. Chapter 4, A Fortress Balance Sheet. J.P. Morgan believed that a strong balance sheet was key to weathering any storm. His was funded by savings, assets, and low levels of debt. That way, if the markets turned against him, he wouldn't be wiped out. Today, this means having an emergency fund, saving for retirement, and paying off high-interest debts. It's about living below your means and spending less than you earn. The basic math looks like this. Income minus expenses equals financial stability. What you spend on rent, food, and clothing reduces your financial stability. But if you save that money instead, you build it up. Then, if something goes wrong, you have a buffer. You can take risks because you're not afraid of going broke. Morgan knew that. He once said, "If you come to me and tell me that you can double my money in 6 months, I won't believe you." He wasn't stupid. He didn't need to take foolish risks to grow his money. He built his fortune slowly and steadily, but most of all, he built it on a foundation of stability. If you want to be like Morgan, then start by building your fortress balance sheet. That way, you can sleep at night knowing that no matter what happens, you'll be okay. Chapter 5, The Long View. John Maynard Keynes once said, "In the long run, we are all dead." That's depressing, but J.P. Morgan disagreed. He once said, "It is not the function of the banker to anticipate the future, but when the future is known to act accordingly." In other words, don't try to predict the future. Instead, prepare for it. This is the fifth and final principle in J.P. Morgan's Playbook. The long view. Morgan loved looking at maps and globes, but he also spent lots of time on trains, so it makes sense that he would favor the long view. He once remarked, "Whenever you forecast, you must forecast as far ahead as possible. It is no good forecasting for a few weeks or months ahead. You must forecast for years ahead." Even though he loved trains, he didn't just look at train tracks extending in front of him. Instead, he looked at the entire network. That's how he built his empire. And that's how you build your wealth, long term. For example, cars were becoming popular. So instead of sticking with horses, Morgan backed Ford Motor Company. Morgan's goal was to create a monopoly. He wanted to dominate the steel market with U.S. Steel. That took years, but he stuck to his guns and he won. If you want to be like Morgan, then take the long view. Don't worry about the next recession. Just keep saving and investing. If you've enjoyed this video, you'll love our follow-up episode on how to become an investor.